I think the market has been thinking about the downside risks, and they've been talking about the risk of a recession or a trade war with China that leads to economic Armageddon. That is why investors only think about the downside. The flip side of all this is that the US actually has a lot of upside for exports, a lot of upside for deregulation, a lot of upside for changing tax policy, incentives for creating investment in the US. And all of that would actually not only expand PE, but also expand earnings. So I think you don't want to get too specific, because at the end of the day, if investors have raised, if cash on the sidelines is $7 trillion and investment sentiment is persistently negative, you don't have to be right. The market just has to be wrong.
Tom Lee says investors are too focused on risks like recession and trade wars, missing big opportunities from U.S. exports, deregulation, and tax changes. With $7 trillion in cash waiting to invest, a market rebound, especially in crypto, is likely when confidence returns. He explains we're in a rolling recession, where some sectors slow but the overall economy stays stable. Key warning signs for a deep recession aren't showing, meaning the slowdown could be mild, giving markets room to recover. Lee is optimistic about stocks and crypto thanks to strong earnings, easing trade tensions, and growing institutional interest in digital assets. He advises staying invested through volatility to catch potential gains.
I think maybe the way I'll start that is there's always a recession somewhere in the US economy.
Sure.
Like in the last 5 years, I might even say 20% of parts of the US economy have been in a recession. Okay. So that's why we call it a rolling recession. And the trade war is probably creating another set of rolling recessions. Now that doesn't mean the overall economy is in a recession, because GDP could just grow slowly as parts of the economy are in recession. I'll give you an example. Housing has been in a recession for 3 years now. And since 1900, prior to this period, whenever housing was in a recession, the overall economy was in a recession. But we've had a housing recession for 3 years, and the US economy has been fine. So the question I think we're all trying to debate is, if we have a trade war recession, like so trade is slowing, is that enough to create an overall recession in the economy? Because we know it's creating a trade recession. And I don't have an answer to that. But the one market I'm watching is the high yield market. If high yield spreads, which means high yield rates relative to risk-free rates, if that reaches 1,000 basis points, then we're almost guaranteed a recession. But it's currently at 367 basis points. So to me, the high yield market is saying we have another rolling recession happening, not a US recession. So that's why I was asking you to clarify, because I think it's going to be too easy for people to say, oh, GM's in a recession, so the economy's in a recession. GM could go into a depression, and it probably wouldn't affect the US economy. But we don't want too many parts of the economy to go into a recession, because then that would drag the overall economy into a recession. Like what you're asking is, oh, if you have a rolling recession, why doesn't it pull everything into a recession at once?
Right.
And
at some point.
Yeah. I think that that's possible, but historically it's required what you call a shock. So for instance, if oil prices spike to $300 a barrel would cause oil to be 15% of US spending. That is a shock, because it's currently $50. But oil has to go up a lot. But in the past, that's caused a recession. The second type of recession is a financial system shock, like 2008. So if the financial system, the banks or credit, has a crisis, then that pulls all the sectors of the economy into a recession.
Right.
But if manufacturing's in a recession or housing, it doesn't create enough ripples. Just keep in mind that in 2023, when the regional banks got into trouble, many people predicted a depression, because they said, oh, the regional banks are going to be the firewall, and if they fail, all credit fails. But we had a regional bank crisis and the economy was fine. But in 2022, we had a series of rolling recessions that have continued. So for 3 years now. And in 2022, the S&P was down 27%. And earnings didn't recover until the second half of 2023. Investors at that time claimed the market was going to have more downside because they thought the rolling recessions and the Fed tightening was going to lead to a bigger economic decline. We had argued strongly against that. We said that credit, the debt levels of consumers was too low to prevent a larger recession. Today, the same conditions are true. Businesses and consumers aren't highly levered. So there is risk of job loss coming, and that's why we could have a recession. But for someone to be so confident that we're going to have a recession, I think they're dead wrong. Sure. And by the way, that's what you're hearing. I think a lot of economists are declaring recession. In my 30 years, I've never seen an economist get the recession right. So the fact that many are claiming there's a recession probably tells me the odds are very low of a recession.
Got it.
We usually go into a recession and economists deny it, and we're already in a recession.
Yeah.
That's what happened in 2008.
Tom Lee says many investors focus too much on recession risks and miss the U.S. economy's potential growth from exports, deregulation, and tax changes. With $7 trillion in cash waiting to invest, a market rebound could be coming soon, especially for tech and crypto. He explains that parts of the economy slow down at different times without causing a full recession. Key signals show a mild slowdown, not a crash. Lee advises staying invested, as this often leads to better gains when markets recover.
I think it comes down to three things. The first is the high yield market never confirmed the panic that we were seeing from the economists about the economy. High yield spreads did widen to like 439 basis points wide. But if we were barreling into a recession, they'd get to 700 or so, and they're back down to like 360. The second is that the stock market did have a liquidation event, as you point out, but waterfall declines, all of them, 17 out of 18 since 1950, had a V-shaped recovery. So we knew that whenever the bottom was established, the bottom would be a V-shape. 2022 was the only real exception because of Jackson Hole. And the third is we had a lot of faith in businesses. These companies have been battle tested. They survived a pandemic shutdown. They survived a bullwhip effect from a recovery. They survived the fastest rate hikes in history. So I think that businesses really should get credit, and they've delivered earnings even for Q1 and for guidance that have been way better given the Armageddon that we expected. So I think those three things are the reasons we sort of told our clients to kind of buckle down and even add exposure. I mean, there's a couple of factors at work. We were highlighting it during the tariff dislocation, but we know that the equity professional universe of investors, looking at political surveys, more than 60% are Democratic leaning. So their interpretation of the actions of the White House was half empty. So we saw an exaggerated move in equities relative to the bond market, where in the bond market it actually is flipped. In the fixed income world, 60% of bond managers are registered Republicans. And so that's why I think you get better signal, at least in this instance, from what the bond market was doing. And the second is, of course, something people have talked about is the 10 best days. We were highlighting this multiple times that if you exclude the 10 best days of 2023 or the 10 best days of 2024, the S&P only returned 3% a year each of those years. So you need to stay in the market, as you point out, in order to get the 20% gains. And I think this year is another example of people rage sold at 48.35, and now they're buying in today. They missed 1,000 points or 20 percentage points of a gain in 2025. Yeah, I've got a couple of pieces of advice. I mean, right now, the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities. And we talk about it with our clients, whether it's Tesla or the Mag 7 or the small caps, there's many opportunities still.
Tom Lee believes investors are too focused on recession risks and missing growth opportunities like exports, deregulation, and tax incentives that could boost the economy and market. With $7 trillion in cash waiting to be invested, a market rebound, especially in tech and crypto, could be coming soon. He also explains the economy is in a rolling recession, where some sectors slow down but the overall economy stays stable. Key signals don't show a full recession yet, so Lee advises staying invested to benefit from likely recoveries. Do you expect a full recession or just a rolling slowdown? How are you adjusting your investments in this environment? Let me know in the comments.